can you shut through?
Hi, it's Ted Ritzer. I'm the host of the Greening Government webinar speaker series. It's a collaboration between my department, Alberta Environment and Parks, and also the Alberta Climate Change Office, and also the Municipal Climate Change Action Center. And basically, our mission is to help governments in Alberta reduce their carbon footprint and also grow their green economies. The format of the sessions is usually 40 minutes presentation, followed by 20 minutes Q&A, and webinar participants can post those questions through an online Q&A window. We're very fortunate to be joined today by the CEO of Corporate Knights, Toby Heaps. And Toby, you know, after kind of reading some of the information on Corporate Knights, I kind of concluded that this is kind of like the world's Huffington Post for sustainability. And in that, I mean that I think Corporate Knights is really interesting in that it combines both sort of online, virtual, digital, as well as print media, like Huffington Post has kind of captured the world's imagination. But when I looked at kind of the stuff that you guys are up to, it started out with a magazine for clean capitalism, and I won't go through sort of the definition of clean capitalism, but Corporate Knights has an incredible reach. When I looked at the materials that Tara had sent, you've got a print circulation of 126,000, readership of 378,000. You got a frequency of 4 issues per year, and you have inserts within both the Globe and Mail and the Washington Post. So with subscribers of 115,000. So that's an incredible reach and such an interesting publication, Toby. So I was really thrilled to have you speak into the series, and I'm pretty interested in the topic that you chose as far as pension powers. So with no further ado, I'll turn it over to Toby Heaps.
Thanks, Ted, and thanks for beaming me into this series. I'm going to cut to the slides because they have some illustrative elements, and so I'm just going to move that over now into the screen share. And so you did a pretty good introduction of Corporate Knights. I co-founded it with a friend back in 2002, and the initial idea was that if we shined a light on the companies that were part of the solution to the big challenges we face in society, that would help to initiate a series of feedback mechanisms that would lead to more incentives for good behavior and less incentives for less good behavior. We've tended to focus more on how we shine the light on the leaders than exposing the laggards, although we do some of that as well. We don't shy away from calling out the really egregious laggards on occasion, but we tend to subscribe to the notion that you can get more flies with honey than vinegar. And so we started out in 2002, and we started out ranking companies on hard numbers, things like emissions per unit of revenue, things like water use per unit of revenue, things like whether or not the CEO's pay is tied to sustainability targets, things like safety records, injuries per 200,000 hours, lost time incidents, fatalities, things like taxes paid, what portion of profits are being paid in cash taxes over a period of time, employee turnover. So a whole range of about really kind of 14 key performance indicators that we helped to kind of advance and evolve along with other forces into more of the mainstream of corporate matrices and decision making. And I think we've been going now for 15 years. We have kind of 3 things that we focus on. There's the magazine, which is our mainstay and the thing that we we're most known for, and that's Corporate Knights magazine, as you said, quarterly. Comes out wrapped up in the Globe Mail as an insert, and also we're proud to say we are on the reading list of the President of the United States, at least the last one, but the new one is also getting a copy through his Washington Post. and we hope he's reading it. Lots of stuff for him in the magazine. And then we have two other divisions besides the magazine. We have a division that focuses on advancing public policy that will reinforce clean capitalism. And clean capitalism, people ask us, what is clean capitalism? And it's a term we coined. So I guess that means we get to define it. And we see clean capitalism as a system that doesn't currently exist in totality, but is an ideal system that we're moving towards and evolving towards. It's a system where the prices fully reflect all of the ecological, social, and economic costs and benefits. And marketplace actors are conscious of the consequences of the decisions they take in the marketplace. And so we see our role as sort of providing information into that marketplace to make it easier for market actors to foster a better world that's in line with their values. So the Council for Clean Capitalism works on various policy measures, things like pricing externalities, things like carbon pricing, things like getting green finance moving, like green bonds. And we've had some notable successes over the last number of years working with some of Canada's finest corporate leaders who have the courage and power to help us push and get some of these common sense policies that can catalyze sustainable development in place. And so that's been a really heartening experience for us to find that common ground with leaders and policymakers to help advance some of those policies. And the third thing that we work on is research. The research feeds right into our rankings in the magazine in many cases. And we've also sort of delved down into research that goes into the investment spectrum and sort of puts a microscope on what's inside our investments and what happens when you start looking at your investments through the prism of your ethics. And so that kind of really brings us to current day. So we've been around for 15 years. Our initial goal was to help usher as many companies as we could into the knighthood in terms of noble behavior, to tapping into the better angels of the human beings that run corporations and large businesses in Canada. We've seen a lot of progress. We've seen progress on policy. We've seen progress on corporate culture. And I think I'd like to think that we've played a small part in some of those movements of progress. And is one example, when we first started measuring corporate sustainability in Canada, almost no companies 15 years ago were linking the CEO pay to sustainability targets like reduced injuries, lower emissions, higher resource productivity. And today, the majority of large Canadian companies are linking the CEO's pay to one of those targets, and it's helping to determine the CEO bonus, in part, not in its totality. So that's one example. And when you start putting something in the pay structure, it sends a message that it's important, and it's become a prime time issue. So happy to see some things moving forward, but I think if we look around, something's missing. And just as three kind of salient points to take out. If we look at gender equity and inclusiveness within the leadership structures of society, using as a proxy corporate boardrooms, at the current rate of progress, we won't reach gender equality in the boardroom until sometime after 2065. And I like to think I'll still be around in 2065. Hopefully you too, Ted, and most of the people here, but people living longer and longer. But that's a long time, 2065. Number two, inequality has gotten so out of control that the world's 8 richest people now have the same wealth as the poorest 50%. So you have 8 people with the same wealth as 3.6 billion people. And if you look at it on other scales, the top 1% has gained just as much wealth as the bottom 20% has lost over the last 30 years. And so we clearly have an issue with inequality. You see it with the extremes and the populism entering into politics. We had an election south of the border where it could have went either way if there were 2 change candidates, both fairly extreme populist messages. It could have gone a Bernie way, it could have gone a Trump way, which it ended up going at least by if you measure it by who's in the White House now. And so inequality is out of control. And if we look at the environment, there are many indicators you can look at. There are many boundaries that we're starting to brush up against or transgress. But one of the key ones, if we just kind of, is a super indicator, we're on track over the next 8 decades to lose half of all species on this planet, mostly attributable to accelerated climate change, which is mostly attributable to the human impact. And so we're living in the age of the Anthropocene. We have multiple stresses. We have leadership structures that are boxing people out. We have inequality, which has reached epic proportions, and we're teetering on several sensitive environmental limits and some that we've already crossed. The good news is we have a lot of wealth in our society, not just in Canada, but globally. We have over $250 trillion of wealth that we have built up and saved through our hard work, through our ingenuity, and through our prudence. Just in Canada, if we look at the top 10 pension plans, this is just looking at the top 10 pension plans, the assets that they hold. AIMCO, which will be familiar to many in Alberta, the Alberta Investment Management Company, which handles a lot of the Heritage Fund and multiple other investment manager for multiple other pension funds and funds of that nature. BCIMC in BC, a similar function in BC, the Caisse de dépôt in Quebec, the Canada Pension Plan, which all of us pay into off our paychecks, HOOP for healthcare workers in Ontario, OMERS, again, an Ontario fund for municipal workers, Ontario Teachers, a huge fund for teachers, the Ontario Pension Board, Op Trust, again in Ontario, and the PSP, the public sector pension for federal workers. And so if we look at just these 10 pensions, you can see in this chart that they have over $1 trillion of assets under them. And this was a couple years ago, so it's higher now. You can see that globally, these top 10 funds we're punching way above our weight for Canadians. We have 7 of the top 30 infrastructure investors globally, and infrastructure is a critical factor in the smooth transition. We have 5 of the top 30 global real estate investors. We have 8 of the top 100 pension funds in the world, 3 in the top 20. And our pension funds are generally regarded for having among the best governance structures in the world. And one of the things, if we look at, say, the Canada Pension Plan, it has been particularly called out for its prudence in diversifying its assets outside of Canada. So not just investing in Canada, where the bulk of the inflows for the pension plan come, but investing overseas and abroad, where the contributions to the fund are not coming from. So if something happens to the Canadian economy, the inflows to the pension fund will obviously be reduced, but the rate of return will not be as severely impacted because a lot of the assets are held outside of Canada. And so that diversification principle, that geographic diversification principle, is something that the Canada Pension Plan is quite proud of, and I think rightly so. It is somewhat perplexing to me that the principle of diversifying your risk has not been applied to sectors, because we are, as an economy, still quite dependent relative to the global economy on the fossil fuel sector, which has been a great driver of wealth, among other things. And we still invest in the fossil fuel sector in the same proportion to which we're vulnerable to it on the inflow side. So there's an opportunity there, I think, to look at further risk diversification by applying geographic risk diversification to sector risk diversification. So all this is to say, our pension plans have a huge whack of money and a huge potential to influence the structure of our economy and the security of our income in retirement. And it's really prudent and really important that our pension funds are taking stock of the big mega trends that are driving the global economy right now. And part of my message today is, I think, is great as our pension funds are at many things, I think they are falling down in some respects about tapping into the mega trends that are happening right now in the global economy. In particular, the transition from a fossil-based energy system to a clean energy-based energy system. And this great energy transition that is one of the defining historical moments in the industrial tides over the last several centuries that is occurring right here and now in quick time over the next couple of decades, is something that threatens to strand many assets, and something that threatens to, and something that also poses an immense opportunity for the assets that we're going to see growing and replacing the fossil-based economy, not tomorrow, not next year, but over the next couple of decades, not the next century, which some people are making the calculations. And so there's a big opportunity for our pensions to get on the right side of this. I think in Canada, our pensions have been reticent to acknowledge this, mostly I think for psychological reasons, because nobody wants us to sort of be viewed as betting against the home team, and I can totally understand that. But from a strictly fiduciary perspective, this isn't about betting against the home team. Just like when we don't invest all of our money in Canada with the pensions, we're not betting against Canada. We're just saying we want to diversify our risk, and we have the ability as investors to choose where we invest and to diversify our risk. And I don't think we're quite doing that well enough. And I'm going to demonstrate a couple of scenarios in a moment that will make that a little bit more clear. So if we get to the point, we've talked a little bit now, and now we get to the point of, do people really want to do something with their investments aside from just fixating on the returns? Do they want their investments to be made in an ethical vacuum? And surveys that are done, survey after survey, finds that no, that is not the case. Over 7 out of 10 people want to see their investments reflect their values to some extent. But on a personal level, less than 1 actually acts on that for various reasons. It's hard. It's not easy to trust information. People fear the potential financial sacrifices. And so you can understand that if this is difficult for an individual to do, it is even more difficult in many cases for an institution like a pension fund to do, because they have fiduciary constraints. It's difficult to say whose values. There's a lot of people around. So it's not necessarily the easiest thing for a pension fund to do. But it is possible, and I think technology is making it more and more possible. So I'm going to cut to a, Tara. I'm using a Mac, so I apologize for the technical. I think I pressed a button, and now I just see the desktop, but my colleague's going to come assist. I just want to get to the website.
Oh, the website?
Yeah. Okay.
Oh.
Let's reload.
It's going.
Takes a second to reload, right?
Okay.
Is it, or how do you make it reload?
No, I think it should work.
Oh, there we go.
Okay.
Okay. So I'm going to share my screen.
I think you already are, I think.
On the left, okay. So let's take the Canada Pension Plan as an example. So this is a matrix that was built using all real market data. So there's the CPP. So we take the CPP, we can take a look at it, see how it looks against the, in this case, I believe the benchmark is the S&P 500. We can see that it's about the same carbon intensity, a little higher fossil fuel exposure, no clean energy exposure, a little lower women's leadership. And we can see it's quite a bit higher on the fossil fuel reserves. And moving down, about the same on tax responsibility. And you can sort of see some of the metrics here. So let's get to the scenario. What would happen if we were to take out companies which pose a severe potential environment risk or stranded asset risk? So if we were to take out oil and gas companies, companies with a link to deforestation through palm oil, with poor rainforest rating, companies who lobby against climate change progress, companies which cause severe environmental damages, a small number of companies, companies which impinge on seafood sustainability, pure play coal companies, coal utilities, and thermal coal miners. And we were to put this into just the remaining companies and spread it according to the size of those companies. What would have happened financially if we did that? So we'll run a little test. It's pressed clean, and it's running the calculations now going back for years. And we can see that with the CPP, which had $80 billion to start with, if we would have done this, 13% of the investments the CPP makes in equities would have failed to align with the selected values. If CPP had done this clean approach, it would have reduced the carbon footprint by 30% and would have made, just over the past 3 years, an additional $2.7 billion based on this simulated backtesting. We can see also would have been slightly lower risk, the Sharpe ratio is a measurement of risk. And then we can see the performance down here. So this is just sort of kind of an interesting presentation of, and you can run these scenarios various different ways. You can see the annualized return is superior by 1% and get an idea of what might happen. And I think some people will make a valid case and say, well, a lot of this was driven by the decline in oil prices, and that affected the price of oil company securities, and that's definitely true. Part of it was also driven by the market beginning to price in the stranded asset risk in fossil fuel companies, but I don't think that was the majority. I think that was part of it. And so going forward, the question is, does it make sense to implement a strategy to diversify away from the fossil fuel sector as an investor, or to retain market weight? Now, I think if you're a trader, a market trader, you're day trading and you think you can beat the market, time the market, you can make a case for why it makes sense to trade energy stocks, fossil fuel stocks. You might make money on the upside or the downside. Getting in and out of stocks is the volatility, trading on the volatility. That's a valid case. But if you're a long-term investor that has a passive buy and hold strategy, which is the case for much of the equity allocations for many of the pension funds in Canada, and for that matter around the world, the case becomes weaker, because in order to retain market weight, even if you're outside of Canada, to retain market weight in the fossil fuel sector, you have to have an investment belief that the fossil fuel sector will perform or outperform the market in general. And I think a lot of people are coming around to the views that, in particular, the oil element of the fossil fuel sector, over the next 10 years is likely to underperform the market in general. There will likely be periods of outperformance within those 10 years. We might see in 2 years or in 1 year. Last year, we saw the oil sector outperform the market marginally. It might happen again this year. But over a 10-year period, I have not come across too many people who think that the oil sector will perform as well as the market in general. So if you have that belief that the oil sector will underperform the market in general over the long term, it then becomes incoherent to include those stocks in a long buy and hold passive strategy. So that's where that comes into. So just to illustrate how some of this might be applied in the context of the personal investor, there are a growing number of tools that are coming into the market to allow retail investors to invest their wealth in a world that they believe in. And so I think the key thing here is it's easier to do this I think, as an individual, because you don't have to find the confluence, the sort of coincidence of everybody's interests and or the fiduciary argument. This is just about individuals being comfortable with implementing their own personal values. So we could run through this and sort of see how it might work. But you get to, this is one example, a prototype that we're honored to be involved in, but there are other really good ones too. So you get in there and it says, so your first step is you click the stocks you want to avoid. The second step, you click the types of companies you would like to invest in. And then in step 3, you find out what the financial impact would be of applying your values. So you can see if it would have helped or hurt returns. And step 4 is you get some resources to act on your values as you see fit. So here's an example of the types of themes that you could choose to exclude. You can see you've got weapons, negative environmental impacts, GMOs, animal mistreatment, gambling, poor human rights, alcohol, tobacco, boards of directors with no women, corruption, inequality, links to child labor. So let's see, we'll go through this. And you see this bar at the top. If you click any one of these themes, the bar will go and it'll show you how many stocks have been taken out. So click this. Now we've taken out, you can see a few percent. Click this, click this, click this, and then we've clicked out 4 of them, and 92% of the investable universe is still available to us. So we go and say, okay, well, let's see where we would like to invest our values on the positive side. You get here and you see, okay, I'd like to invest in clean energy solutions, sustainability solution providers, and that's a high priority for me. And then you press continue and you input what your investments are. So in this case, I'll add a TD fund here and click the amount, 10,000. And then you go to calculate your return on values. And that's a quick calculation. It's identifying the misaligned companies, investing in the aligned companies, and calculating your return on values. And you can see that 8% of the companies were misaligned. In the custom portfolio, 0% are. And you can see your return in the custom portfolio is slightly higher, 8.7 versus 8.6. And if you look at the comparison graph, you can get an idea of how the performance went. You can see you have 263% more clean energy. You have 150% more sustainable solutions. And then if you want to dig down here at full impact facts, you can see the average CEO to worker pay, female directors, carbon footprint, percent of taxes paid, and so on. And so up here you have your values dashboard. You can click to edit if you like. And so this is, I think, the future of investing. And this is something that we'll see happening, becoming more common for retail investors. And this over here is the type of tools that institutional investors, pension funds are starting to use. And it illustrates what the sort of potential implications, financial implications could be of investing with your value, with your values. So I think that about brings me to the conclusion, and be happy to engage in discussion. I think I may have made some somewhat controversial points, and I'd be happy to engage in a civil dialogue, and any comments or criticisms are all quite welcome. So I'll put the camera back on to me.
Okay, so for our audience members, there's a Q&A function. If you just hover the cursor, and I'll open up the Q&As for people to pose questions. But while they're chatting, Toby, more insights on what you had in mind in terms of pension funds, because that's a really interesting idea. And just thinking of myself and other folks that I work with, I mean, that slide that you showed as far as the willingness to invest in sort of green or sustainable, or I think it's a really valid point that a lot of people from the public pensions would probably like to see investments made in the type of direction that you were chatting about.
Yeah, I think and this is happening in other countries with large pension funds, like the Norwegian Sovereign Fund. They have a whole range of criteria they implement. So they won't invest in companies that have egregious ethical violations. So companies who have severe environmental damages, severe human rights conflicts, child or forced labor, thermal coal mining or burning. They do invest in fossil fuel companies and oil companies, but they don't invest in coal. And what's interesting about coal is thermal coal is responsible for, depending on exactly how you measure it, north of 40% of global human-caused greenhouse gas emissions. And if you look at the carbon intensity of a portfolio, the big chunk tends to be coal, but coal is only about 2% of the investable universe. So you can take 40% of the carbon off the table just by taking 2% of the stocks off the table. And oil tends to be a smaller share of the global greenhouse gas emissions, quite a bit smaller of most portfolios, even in the order of sort of 8 times smaller footprint than coal. So that's what the Norwegians do. They have a defined list, they publicize it. Their performance is strong. And I think they don't have the same risk we do to stranded assets in the utility sector and the coal and thermal coal. So I think there's a big opportunity for our pension funds to look at, I would say, getting out of fossil fuels entirely, maybe in their trading accounts, but for their buy and hold strategies, out of fossil fuels entirely, and getting out of companies that engage in egregious practices that are antithetical to widely held values and legal norms in this country. And so we've signed the personal landmine treaty. We shouldn't be investing in companies associated with landmines, and many of our pension funds are. Cluster bombs, again, we're talking about a minuscule portion of the traded securities, but we shouldn't be, most people, almost nobody wants to be investing in cluster bombs. It doesn't affect performance either. The few handful of companies that are have been found to be guilty of egregious use of child labor, no reason to be invested in those companies. They have many risks too. You take all these companies off the table, it's maybe 100, 200 out of the sort of 5,000 biggest companies. And so you still have 4,800 out of those 5,000 companies to invest in, and you can still do quite well. And I would even argue, I think modern portfolio theory suggests that if you reduce your investable universe, you'll reduce your returns because you have less options. But that assumes that the companies that you're saying you won't invest in are just, there's nothing different about those companies from the regular population. But the thing is there is something different. Those companies are involved in, they're on either the wrong side of history, economic history, or they're involved in egregious practices. So if you take those companies off the table, you're actually taking a source of potential future underperformance off the table. And there's an argument to be made, and I think a lot of our testing would bear this out, that you get some marginal benefit financially from doing the right thing, which is really difficult for people to swallow, because I think we're hardwired to think there always has to be a trade-off. You do something that's ethical, you're going to pay a price. And I think the thing is with the world going the place where it's going with 9 billion people and brushing up against resource constraints and environmental limits and other types of social limits, the companies which made money in the past by creating externalities are now being asked by society to pay for those externalities, whether it's a carbon price or the fair share of taxes. And the ones who are playing fair and playing in nice ways are prepared for that world that we are, I would say, already in and accelerating into. The ones who were dependent on that old world of being able to externalize costs onto the rest of society to profit, those companies are vulnerable. And so I think there's a strong case to move this way. And I think Canada maybe has more of a reason than almost any other country, not just because we helped to create the landmine treaty, and not just because we are overexposed as an economy to the fossil fuel sector. So we have, from a risk hedging perspective, quite a motivation to diversify and to hedge some of our risk on the investment side. But I think for all those things combined, and some other reasons, there's a really strong rationale for why to do it. But it's not happening, and we're losing. We have lost billions of dollars of public pension wealth. So that's your and my retirement dollars, billions, and we have put further billions at risk as a result of not accepting this. So I think this is a real serious conversation that is important to have, both with an ethical and a financial lens.
Well, I guess I would ask a question of you, Toby, about your understanding of the scale and size of the AIMCO or Alberta public pensions. I think a lot of the folks viewing, that's their pension because they are working for a government in Alberta. So if you have any insights into our pension funds.
Yeah, sure. So I think AIMCO is, they're doing some things that I think are quite encouraging. They're measuring the carbon exposure of various funds. They have a team of environmental social governance experts that are engaged with the leadership of AIMCO and are closely monitoring the portfolio. As far as actual investments, I think that AIMCO is still quite exposed to the fossil fuel economy, and that's a huge source of risk for people who have wealth in that, because that means not only have you lost wealth over the last 5 years, substantial wealth, but going forward over the next 10 years, there's a huge risk that there'll be even more wealth lost. And it doesn't look like the investment managers have accepted that. And I think one way to get around this is, there's an accountability issue here. If you work in a major pension fund, whether it's AIMCO or CPP, and you decide to do something different than what some of your other major peers are doing, you're the sheep that just stepped out of the flock. That makes it much easier for you to get shot, even if you're right. If you're in the wrong spot for even a year or a few months, you're taking a bigger risk. So there's much less career risk and there's a lot of institutional inertia to stay within the flock. But I think there's more motivation for a fund like AIMCO to get out of the flock because of the serious financial ties and the depth of exposure to the fossil fuel sector that already exists. But it comes down to, I think, accountability. So if AIMCO is going to stay invested at market weight in the fossil fuel sector, given the gravity and the tremendous scale of the energy transition that is underway and its macroeconomic significance, I think it's incumbent on AIMCO to take a view on how they think the energy transition will affect asset values in their portfolio. And it's perfectly legitimate and acceptable for AIMCO to take a different view than what I've taken, or what a lot of other people have taken, and say, we believe that that within the hydrocarbon part of the economy, the fossil fuel sector part of the economy will be able to survive and thrive through this energy transition and perform as well or even better than the market. If they take that view, then it's perfectly rational for them to hold on to the stocks. But they have to take that view. They can't just sort of hide behind something and not take a view, given the gravity and the seriousness of this issue. But if they take a different view and they say, well, we think that the risks posed by the energy transition, the new market for global oil prices, we think the risks this pose suggest that there will be underperformance for the fossil fuel sector over the next decade, then that has significant implications for asset allocation and investments that, again, AIMCO can be held to account for. So this is this is not an area to tread lightly into, but I think it is important, given the gravity of these issues economically, that and the importance of an institution like AIMCO, that they do take a view. And this is a argument that has been put forward by the former head of risk and quantitative strategy for Goldman Sachs, Bob Litterman, and other leading fiduciaries like Ed Waitzer out of the York Law School, one of Canada's leading fiduciary thinkers. So this is not an out there idea. This is just about doing your job. And I think that's a really reasonable thing to ask. And I think it would lead to a lot of interesting discovery and potentially help to better secure the retirement finances for Albertans.
Well, Toby, when you look at the two sort of fundamental directions of this speaker series are about helping governments reduce their carbon footprint and also grow our green economy here in Alberta. If you have any insights that you would like to share with government workers in Alberta.
Sure. I mean, I think it's good that the government is putting a price on carbon. I think it's great that the government is going to be investing more in energy efficiency and in renewables. I think that I do believe that there are at least some missed opportunities, some of which are really critical. So the government's going into a lot of deficit right now and debt. It still has a pretty good credit rating, still can borrow pretty cheaply. And there are really two things. When you look about what is it going to take for Alberta's economy to make the transition to the 21st century economy? Well, it's going to be decarbonization of the energy supply. And what I see is more of a dash to gas, getting off coal. And I think it's pretty imperative that the companies who bet on coal don't get bailed out by the public. And I think the government's been a little softer than they need to on the coal companies in that regard. I think if you're in the private market, if you're a businessman, businesswoman, you invest in something, you take a risk, you profit if you're right, you lose if you're not. If you invested in coal and you lose, you lose. So I don't believe in the bailouts there. But the two critical things I think that Alberta could do is, number one, tap into the hydropower potential. And so there's been ample work done in the north of the province. There's at least 3 sites where you have north of 1,500 megawatts of run-of-river potential. It requires artful dealings with the Aboriginal communities, but nothing that is impossible that cannot be done. The pie is quite big enough. It requires low-cost capital, and the federal government has made noises that they're interested in backstopping this type of thing. And you need to build the transmission capacity to rescue the stranded hydro assets and bring them onto the grid. And that replaces the baseload coal instead of going to gas, which has pollution issues and also over the long term huge operating cost issues, and also emissions issues given the additional methane leaks that happen when it's the natural gas is being harvested. So it's not even clear that natural gas is better than coal when you factor in the life cycle emissions. And so I think the hydro is a huge opportunity for Alberta, and I think the current government kind of sidestepped that. And when I tried to ask some of the senior leaders about it, they kind of sidestepped me just when I tried to buttonhole them in some private encounters. And so I think that is a major opportunity. I'm not saying it's easy, but I don't think doing big consequential things for a country ever are easy. But this is something that Quebec did it with their hydro, and look how it's transformed their economy, their energy security, their price of electricity. There are billions of dollars of exports to the US. So these are all opportunities Alberta could have with this tremendous hydropower assets in the north. Not all environmentalists advocate this, obviously, because it is going into some beautiful untouched rivers. But we're not talking about massive dams. We're talking about run-of-river with environmental implications. But on a net analysis, I think it's a huge opportunity for Alberta. The other opportunity is the petrochemicals in Alberta, I think, are quite valuable. Probably not as gasoline and just fuel into moving vehicles. I think that type of market will get taken over by other lower cost producers. But the bitumen that we have in Fort McMurray and surrounding areas is rich in many other types of minerals, and it can be used for advanced materials. And I'm not talking about diesel or gas again, or benzene. I'm talking about advanced materials, different petrochemical applications. This requires big investments. A lot of people have said, oh, there's overcapacity here or there. I don't necessarily buy that. I think there is a big opportunity on the petrochemical side. And I'm talking about a step change from existing proposals that are on the table. Things that could actually harvest the real value that is in Fort McMurray, and things that would also insulate us against some of the mispricing that we see when we sell into a single market predominantly and can be held over a barrel. I think the costs of having to sell into the US market have been in the tens of billions of dollars of lost revenue because of the pricing power that we don't enjoy. But if we could make value-added petrochemical advanced materials from the feedstock of Fort McMurray and then export that by train to global markets, I think there's a much better opportunity. There's a much better long-term opportunity for petrochemical products as the energy transition goes away from the combustion engine to electric cars. So that's an opportunity that could go into the multiple decades, into 50, 60, 70 years for Alberta. Hydro is one that could go into the 50, 60, 70, 80, 100 years, as Quebec has proven. Those are all big decisions that take political courage and pose risks. And I think if those decisions are not made, then what has Alberta got to do when when people are not using oil to make gas to pump to move their cars? What's going to happen to Alberta?
Well, I think that there's an elephant in the room as far as looking at climate change and the objective science behind that. And I think we have seen, over the last 2 decades, a shift in realization of the objective scientific information that validates climate change. I mean, a political jurisdiction is not going to change the physical fact of climate change. So then you have a proposition of within North America, politicians are forced to take a look at, a jurisdiction that chooses a different direction, and then you have, opposition and discussion about, to remain competitive, what do you do if one jurisdiction is going in a significant direction? So that's the political challenge, and that's not my problem. I'm just trying to provide information for growing the green economy, and helping us with the transition. But it's a challenge right now within North America.
Yeah. I mean, I think the electoral result that we saw in November certainly put a speed bump on the road for some measures. But I think it's interesting if we look around the world, what Europe is doing, what China is doing. And the United States is still important. The United States is much more than Washington, D.C. The United States includes California, New York, and it has a really powerful state system as well. And the dynamics in those states are still firmly pointing towards clean energy. But if we look at global investment flows being, at the margin being driven by China, we have significantly more capital and capacity going into renewable power than we have going into fossil fuel power. And we see a huge reduction in investments into liquid fossil fuels. And we see the oil dynamic changing with the Saudi Arabians and other cheap oil producers recognizing that the gig is going to be up. The combustion engine days are numbered. The economics of electric cars are coming down just as fast as the economics of the cost of solar came down. So the cost curves on electric cars, on storage, are coming down quickly. And we're if you look at Bloomberg's projections or McKinsey's projections, we're talking about in the next 15 years where the majority of new cars sold are no longer combustion engines. So we're not talking about sometime, later next century. We're talking about a relatively short period of time. And when that happens, the dent it will make to global demand for fossil fuels, a good component of which is put into cars, will be huge. The message that will send to cheap oil producers that you have to pump it faster to get some value while you still can will also be huge. And the implications for the oil price will be huge, downward huge. And what that means for high cost producers like us here in parts of Canada will be huge. So what horse we bet on today is really going to have huge implications for the wealth of our own generation, but certainly our kids and definitely our grandkids. And so, regardless of what the new president does in short-term blips and animal spirits that get activated in the marketplace, those long-term dynamics, the economics of clean energy and energy storage and electric cars, those are trains that have left the station, and it's just a matter of time. And it's not actually that long of a time before we see the redundancy of fossil fuels to power and move the economy.
Well, I guess another question, and we haven't had any questions through the Q&A function, but one of the things that I wouldn't mind your thoughts on, Toby, and I'll just kind of put it out here, a little outside maybe your expertise, but what we've kind of found through this series, certainly there was a presentation by Dr. Peter Arnfalk from Lund University in Sweden, and what he studied for a period of, I think it was about 4 years, was the government of Sweden has a policy where they basically discourage business travel and encourage the use of technology like what we're doing right now for virtual meetings. And what they found was the ministries that subscribed to that philosophy reduced their carbon footprint by around 9%, and the ministries that said no way, they actually increased their carbon CO2 emission by around 10.4%. So there was like a 19% spread within the government of Sweden. So what that starts me to think about is there's this kind of you have the technology and then you have social innovation, but the government of Sweden has demonstrated that you can actually make a difference just in the way you operate. And that's certainly central to what this whole speaker series is about. And that leads you to start thinking about internet scale responses to climate change with that combined social and technical innovation. Just be interested in your thoughts on that.
Yeah, it's a great idea, and I think you have great companies in the West like TELUS who are laying down multi-billion-dollar investments to really make the digital economy hum in a way that allow people not have to get out of their seats. And sure, person-to-person contact is hard to substitute, but we're not that far away from us having a conversation where we're in the same room and see holograms of each other. We're wearing VR goggles, and it looks like you're sitting across the table. I'm not looking at a computer. I'm actually seeing you, and the coffee cup on the table that I'm looking at, you're looking at. So that we're not that far away from that world. And yeah, that makes it easier to connect on a more human level through technology, which is really when I think technology starts realizing its true calling and purpose. So that's great. And we can still move around. We can still. I like to in our office. I like to go talk to people rather than send an email.
Yeah.
The person to person, or to pick up a phone rather than send an email. The more human the contact, I think, the better. In this day and age of bombardment by electronic communications. So yeah, that's great. I mean, I think, and we can reduce the footprint of moving when we do move. I think if we sort of look at the three C's of climate change, it's cows. It's about it's like about 7% of beef is about 7% of climate change. We've got coal. Like I said, about 40% burning coal, and we've got cars, depending on how you measure it, 10, 14%. So the majority of emissions are coming from cows, coal, and cars. And we have policies that are in place in various jurisdictions to deal with that. In India, it's illegal in provinces, states to eat beef. In Oslo, they're going to be banning cars from the city center by 2020. So that's not all cars, just combustion engine cars. And in Ontario, it's illegal to burn coal. It's actually illegal to burn coal. And so we have the policy basket, and we mix that with the digital strides that we're making, and we have better quality of life, cleaner environments, and more productive, thriving societies.
Well, and interesting on the comment about cows, we had some German imports in terms of expertise actually helped establish the Lethbridge biogas plant where that cow manure and vegetable matter is being converted into electricity. And the folks that presented on that, Toby, it was really interesting. Their point was it's not like wind or solar. Once the process starts getting going, it continues. So you don't have peaks and valleys of energy production from bioenergy. So hopefully we've started to establish a positive model of what you can do with essentially cow manure and vegetable manure to create clean energy, which was a real surprise for me. I didn't understand that until the folks presented on that topic.
Interesting.
Yes. Well, this has been fascinating, Toby. It's been wonderful to have you present. And I just give you one last chance, parting words from you, anything that you'd like to say in conclusion.
Just thanks for the opportunity to have this discussion, be part of the series. And I would say just, if you care about your pensions, ask INCO to come out with a formal view on how the energy transition will affect their investments going forward.
Excellent. Well, thanks so much for taking the time to present for us, Toby. It's been wonderful.
Okay, thanks, Ted. Take care.
Okay, take care.